It's 9 a.m. here in New York City on this Monday, December 30th. Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Shauna Smith alongside Madison Mills, and let's get you the three things that you need to know today.
First up, stocks kick off the final trading week of the year in the red. Futures falling after the S&P 500 and the Nasdaq 100 both slid more than 1% at the end of last week. Tech stocks led those declines. Meantime, tech mega caps bore the brunt of that sell-off. The Mag 7 still accounting for more than half of the S&P's gains in 2024. Meantime, the rally in Bitcoin fizzling out after a banner year for the digital token. The asset is down $15,000 since it hit a record high in mid-December.
Plus, South Korea officials have ordered an inspection of all Boeing 737-800 plane models after the nation's deadliest plane crash in its history over the weekend killed 179 people. A possible bird strike and an unusual landing gear failure are the main points of focus. Investigators are preparing to analyze the flight recorders for clues on South Korea's worst civil aviation accident. Shares of Boeing declining as much as 5% this morning.
And Jimmy Carter, the 39th U.S. president, has died at the age of 100. Carter became a Georgia state senator in 1962 and later became the state's 76th governor. During his 4 years in the White House, Carter oversaw a tumultuous period in U.S. history. On the economic front, he had to cope with record-breaking inflation and an energy crisis. Carter established the U.S. Department of Energy and the U.S. Department of Education. Geopolitically, he orchestrated the Camp David Accords between Egypt and Israel and oversaw the normalization of diplomatic relations with China.
His final year in office was dominated by the Iranian hostage crisis. Carter's failure to quickly rescue American hostages being held by Iran significantly contributed to his loss in the 1980 election. Carter was very active post-White House. He took an active role in Habitat for Humanity International. He also established the Carter Center in collaboration with Emory University to help fight for human rights, end conflicts, and improve healthcare. His significant humanitarian contributions led to Carter being awarded the Nobel Peace Prize in 2002. In his personal life, Carter was known for his love and devotion to his wife, Rosalind, who died in 2023. He is survived by his 4 children, as well as several grandchildren and great-grandchildren. President Biden announcing that Thursday, January 9th, will be a national day of mourning in honor of former President Jimmy Carter, who died Sunday in his hometown in Plains, Georgia, at the age of 100. Carter served 1 term in office, leading the country during high unemployment and stagflation. We want to hone in on his fight against inflation and his appointment of Paul Volcker as the Fed chair. Joining us now for more on that, we want to bring in Yahoo Finance's Jennifer Schomburger. Hey, Jen.
Good morning, Shauna. That's right. Former President Jimmy Carter's 1 term in office was plagued by record-breaking inflation, propelled by a Mideast oil price shock and a sluggish economy. It was those actions that drove Carter to appoint the now infamous Paul Volcker to the Federal Reserve as chairman to right-side inflation. Volcker would go down in history as the Fed chairman to institute the most aggressive rate hiking campaign in history to break the back of inflation. During Carter's term, inflation topped 14% in 1980, and the Fed would hike rates to 19% in the final weeks of his administration. Contrast that with today, where under President Biden, inflation rose as high as 9% in 2022, forcing the Fed to mount the most aggressive rate hiking campaign since Volcker, with rates topping out at 5.25% to 5.5% this year. Carter also signed the Federal Reserve Reform Act into law, which aimed to increase the transparency and accountability within the Federal Reserve System. Back to you.
All right, Jen, thanks so much for breaking that down. For more on the legacy of Jimmy Carter, we want to bring in Alan Lichtman. He's a distinguished history professor at American University, and we also want to bring in Ambassador Mark Ginsburg, the former White House Middle East advisor under former president. Thank you so much to you both for being here with us. Alan, let me just start with you and talk to us a little bit more about President Jimmy Carter's legacy. We just had Jennifer reporting on some of his policies, everything from the Fed and then to energy to education. But walk us through just how some of those policies helped shape the American economy today.
You know, we hear a lot about evangelical Christianity today. Donald Trump claims to represent that group. Jimmy Carter lived his evangelical Christianity. He was the most devout president we've ever had, and his spirituality affected everything he did. And it was in a very positive, not kind of a negative us versus them attacking mode. He lived a exemplary moral life, and he dedicated himself to helping others, particularly the needy, the sojourner, the stranger, those in need of help. And he tried to model his presidency and his post-presidency on those humanitarian values. He moved us towards energy conservation. You mentioned he was instrumental in probably the most important Middle East treaty of recent times, the Camp David Accords that made peace between Egypt and Israel. He tried to pursue a human rights policy abroad. And then all of this was reflected in his post-presidency. Of all presidents, Jimmy Carter's leadership cannot be summed up in his 4 years as president. He was our most significant former president, devoting decades to fighting the scourge of disease in less developed countries, monitoring elections, working for international peace,
Right.
trying to diffuse conflict. We talk a lot about the lack of affordable housing today and the rise of homelessness. Well, Jimmy Carter was doing something about that through his work with Habitat for Humanity. And, you know, while we do tend to focus his presidency on the tragedy of the Iran hostage crisis, the stagflation, it wasn't just high inflation, it was high inflation and unemployment. There was so much he did in a positive way. Camp David, SALT II,
Right.
moving us towards energy conservation.
And Alan, I want to pick up on that exact point, the Camp David Accords. And Ambassador Ginsburg, I want to go to you on this because, as Alan was just pointing out, Jimmy Carter really brokered that historic treaty with Israel and Egypt. And I know you have such an expertise in the Middle East. Can you talk to us about the historic significance of his foreign policy work and perhaps any lessons that could be held for the incoming administration in that work?
I had the privilege of serving on his senior White House staff, working on the post-Camp David Palestinian autonomy negotiations for the president, working directly with his envoys, traveling with his envoys to meet with President Sadat and Menachem Begin, the prime minister. And the legacy of the president, and a legacy that I had the privilege of spending time discussing with him when I was ambassador to Morocco and when he came to spend several days with us with his wife, Rosalind, led me to conclude the following. His legacy in the Middle East was almost too premature. He negotiated, obviously, one of the most formidable and important peace agreements between Israel and Egypt, but most importantly, he set the stage for what essentially was a search by the United States for Palestinian statehood. He's not given enough credit for the perseverance that he committed to this, something that obviously has not been achieved. But more importantly, what he also did was set the stage for Israel to be able to begin the framework of negotiating peace with other countries, which ultimately led to a peace treaty with Jordan as well.
And Alan, also his legacy extends far beyond the White House. A lot of times when you think of Jimmy Carter, obviously you think of the 4 years that he spent inside Washington, D.C. But talk to us just about how effective he was post-presidency in some of his humanitarian efforts and the impact that that still has, obviously, to this day.
Well, I'll give you a perfect example. When I was in Morocco as ambassador, he and Rosalind came back and stopped over after spending weeks trying to eradicate the guinea worm disease in Africa. I mean, his work for Habitat for Humanity is obviously something that the American people know most about. But what they probably don't know as much about is his commitment to eradicate diseases in Africa. And he spent an enormous amount of time in Africa, as well as in other impoverished countries around the world, almost leading the framework for what essentially became the mission of the Gates Foundation. So the Carter Foundation essentially brought remedies, vaccines, doctors to help begin the framework of eradicating some of the worst diseases in Africa among children.
Alan, I want to go back to you on something that you mentioned, and that was stagflation and the historic inflation that occurred under the Carter presidency. What was the defining factor, would you say, of his ability to support Volcker, the Fed chair at the time, in combating inflation?
Well, inflation was a five-alarm emergency for Carter, and he felt that very strong medicine was needed to break the back of inflation. As you say, we were panicking about 9% inflation, yet under Carter was 14 to 15, and unemployment was high as well. This was a critical factor in his losing re-election in 1980 when Reagan talked about the misery factor. But if I may, I'd like to tell a personal story, which nobody knows, which I think really is emblematic of the kind of person Jimmy Carter was. May I?
Yeah.
Yes. In 1979, I was a serious runner, and I was running in the Catoctin Mountain 10-kilometer race right outside the presidential retreat at Camp David. And I looked to my left, and a few yards away from me is this skinny, pale guy who looked like he was wearing his underwear. And I'm thinking, oh my God, that's President Jimmy Carter. I can run with Jimmy Carter. But I decided, no, I want to win the race. I didn't, but I did okay. I'm going to run on my own. That was the infamous race in which Jimmy Carter collapsed. And that was big national news, emblematic supposedly of a collapsing presidency. It wasn't all that surprising. It was the hardest race I was ever in. 5K down and then 5K straight up the mountain. But here's the real story that nobody knows. After the race, we gathered when they give awards to those who did well. And guess who shows up with no press, no fanfare, no PR? Jimmy Carter. And he gives us this incredibly uplifting, extraordinary pep talk. 45 years later, that's still seared in my brain. That is really emblematic of Jimmy Carter, not the collapse about which everyone was speaking at the time. And we hear all these pious words from these politicians about what an extraordinary person he was, how he lived and represented his faith. But all of those words will be meaningless unless we take to heart what President Biden said. Judge Carter not by his words, but by his deeds. We need to take to heart his deeds and internalize some degree of Jimmy Carter in ourselves to try to combat the polarized, toxic politics of our own time that Jimmy Carter, was just the opposite of representing. Unless we can turn these pious words about Carter into deeds and into representing Jimmy Carter in our own time, it's all going to be wasted.
Yeah, and Alan, thank you so much for sharing that personal story. It just really gives us a better picture and better idea, obviously, of who Jimmy Carter was as a person. Ambassador Mark, as we do wrap up this conversation, I want to bring it back to foreign policy, just given the role that you played within the Carter administration and also just where things are today. When it comes to the current policies right now on energy, on foreign oil, we know obviously Carter really emphasized dependence here, less dependence, reducing our dependence on foreign oil. How did his policies really influence strategies that you're seeing play out today in the Middle East and beyond, and what that tells us about our energy independence going forward?
Well, it's interesting because obviously after the peace agreement between Israel and Egypt, one would have hoped that that would have led to what essentially, and if you go all the way forward to what President-elect Trump tried to accomplish, which is to consummate peace between Israel and all Arab Sunni states, including under the Abraham Accords. Jimmy Carter started this process, but he had a willing partner who unfortunately gave his life, that is Anwar Sadat, for signing that peace agreement with Israel. And when you look at the Arab world and you look at the legacy that he left behind, he's not given enough credit in the Arab world. And frankly, his efforts to push for a Palestinian homeland after the Camp David negotiations soured his relationship with the then Israeli Prime Minister Menachem Begin. So Jimmy Carter, regrettably, is not remembered historically very favorably, believe it or not, inside Israel because of his efforts to push for a Palestinian homeland. But just moving the globe for a second, I mean, he helped solidify the relationship between the United States and China. And at the time, under Deng Xiaoping, he managed to, in effect, create an era of great goodwill between the United States and China. Obviously, something that is lacking right now. And as Alan mentioned, my good friend Alan mentioned, the SALT agreements that he helped negotiate with the Soviet Union were critical in helping to bring about a period of arms control negotiations that led to further type of negotiations, which unfortunately have begun unraveling as a result of the war in Ukraine.
All of these challenges really reminiscent of the challenges we're also experiencing today. So thank you both for giving us such a great overview of the Carter presidency and his legacy. Really appreciate it.
Great to see you, Mark.
We're going to turn now to today's trading action as we kick off the last week of trading for the year. Markets on track for their third day of losses. Moving to the downside here, you can see the S&P is down over 1%, as well as the Nasdaq getting closer to declines of 1.5%. And the big question for us this morning, Sean, is what happened to Santa? We're supposed to get the Santa Claus rally, and we're certainly not seeing that. All of the major averages were able to eke out that weekly gain last week, but will we get to see the same this week? Is it more profit taking heading into year end, or is it a sign of something a little bit more sinister with the concentration in these tech names?
Yeah, and I think that's exactly what investors, what traders are trying to suss out right now, just exactly how we should read the last, I don't want to say 24 hours because obviously you're going back to Friday, but the last 24 hours of trading and what we have seen play out, and obviously a bit of a reversal. It started off on a high note when you take a look at what we saw on Christmas Eve, and then obviously we saw the reversal of that going back to Friday. So I think here we stand, we have 4 days left in the Santa Claus rally, potential Santa Claus rally. So that's very important to point out. There's still time to turn this around, and it's too early to jump to any conclusions. But one stat that I wanted to point out, just 58% of S&P companies right now are trading above the 200-day moving average. The reason why this is significant is it's the weakest reading that we have seen all year. It ends the streak that we've seen of over 260 days with more than 60% above the 200-day moving average, which is the longest streak that we've seen since 2021. You talk a lot about the momentum trade and how much of a factor that has really been here to the melt up that we have seen over the last several weeks. So if we do see less participation and more of a decline here, obviously a bit worrisome here for investors.
Especially given the fact that so much of the gains have been concentrated in the Mag 7, up 70% year to date on a price return basis. What does that look like moving forward with price targets, obviously at record highs for 2025? Keep it
right here on Yahoo Finance. We've got much more coming up. That's coming up ahead on Morning Brief. Go now to the New York Stock Exchange with a moment of silence for former President Jimmy Carter.
You were watching there a moment of silence being held at the New York Stock Exchange for Jimmy Carter, who died on Sunday. We're going to turn now back to the market trade. Futures are lower heading into the fourth trading session in the so-called Santa Claus rally period. That comes after tech sell-off on Friday wiped out early gains. Joining us now to discuss more, we've got Josh Wine, Hennessy Funds Portfolio Manager. Josh, it's great to have you on here. I want to start on some of the action that we are seeing in the markets right now, this move to the downside heading into year end. And obviously we do still have a couple days left for that Santa Claus rally. But what do you think is going on right now? Is this end of year profit taking, or is it something perhaps more sinister?
Yeah, I don't think there's anything sinister. Yeah, great to be with you. I think that November, the sharp rally after the election on this idea of lower taxes and less regulation and so on and so forth, I think kind of borrowed some returns from this month. So December's been rough. I don't think there's anything more to it than just a great year and some profit taking, some tax loss selling in those stocks that deserve, that are down for the year. But yeah, it's been a great year. So I don't think anyone should read too much into an off month.
Josh, what about what lies ahead? When you talk about January, the first couple of weeks, lots of talk about heightened volatility, given the fact that we are expected to see that until the inauguration. How should investors then prepare?
I think investors need to think a little bit more about how they're invested, needless to say. And I say that meaning that, the average investor is very exposed to the S&P 500, which is a cap-weighted index, which, people should know if they don't already. And so what you have in that is, the market is expensive, but I would say that stocks are not. So in the market, you have the S&P trading at about 25 times earnings, which, given the growth in some of the tech stocks that we talk about all the time, like Nvidia, you have a relatively undiversified, expensive portfolio. And I would caution people that as they look to the new year to focus more on stocks. So the S&P on an equally weighted basis is about 18 times earnings. So 25 times market cap, I think we can all agree that's not cheap. 18 times, a lot more reasonable. And I would, encourage investors to kind of look at stock picking rather than just getting market exposure. I think market exposure this year is fraught with risk. I think stock picking is alive and well.
Well, it's interesting you bring that up because, yes, it's expensive, but also I wonder if investors can really afford to not be in some of those expensive names. For example, Nvidia, obviously the outperformer of the Mag 7 year to date, you could argue is expensive, but it's also giving investors the greatest return.
Yeah, no, it's true. And so certainly for those that have missed out, it's completely understandable. These are great companies. I mean, Nvidia and Microsoft and Alphabet and so on and so forth, they're great companies. And if need be, they'll grow into their valuation. They will grow without a doubt. They are great companies and they're here to stay. I think with that, though, comes a lot of volatility in names like that. So it would never be to, lose that exposure to technology that has done so well and likely, 5 to 10 years from now will be appreciably higher. I think it brings a lot of volatility, though. I think, mid-cap names, which, we're well exposed to, trade at about 18 times, this year's earnings. And I think with that comes a lot less volatility, a lot less business risk. and something that people need to be looking at.
Josh, what would you say is the biggest challenge to this bull market? Is it rising yields? Is it high valuations? How should investors be evaluating that?
Well, it does seem like the biggest challenge has been, this idea that the Fed in the next 12 months, likely will lower rates one time, perhaps two. I think just a few months ago, we were looking at 3 or 4 times, maybe a year ago, 5 or 6 times they would be lowering rates. And that's not happening, it seems. At least that's the way the market sees it. I think that's the risk, is that people are still so focused on rates and the Fed. Now, focusing on rates always makes sense. Focusing on the Fed as much as we have as an investment community for the last several years, I think is going to be a thing of the past. I think this year it's about earnings. It's about companies hopefully growing and expanding margins and making good decisions and all of that. I think the challenge will be kind of getting back into that game of actually hearing what companies have to say instead of focusing on what Jerome Powell, is thinking at the moment.
Well, you mentioned the importance of stock picking, and you sent over 2 stocks that you like, Brinker and Ring. Can you talk to me about your base case for those?
Sure. Yeah. So in our Hennessy Cornerstone Midcap 30 fund, we own, a name like Brinker. So we're looking at earnings growth, valuation, and stock price momentum. So, what that brings into the portfolio are a lot of names that are kind of forgotten about. And so Brinker's had a great year. They own Chili's and Maggiano's Italian eatery, and it's a great name. There's growth. They've been able to offer value to diners, which has been hard to find with food price inflation and all of that. And it stands out, taking share from names that have suffered, obviously, like Fridays and Denny's, and even names like Starbucks have suffered this past year. So that's a name that we own in the portfolio. It's done quite well. And then also Ring Central. So same idea, of momentum and, valuation and growth, expanding margins. It's a cloud-based provider of telecommunications solutions for small and medium-sized businesses, and, margin expansion, growth, free cash flow generation. It's a name that doesn't get a lot of attention. It's no Nvidia, but, a lot of great fundamentals there. And it goes without saying, a lot of these companies are always, subject to, M&A and the like, a lot of cash on the sidelines. So we kind of like the mid-cap space.
All right, Josh Wine, thanks so much for taking the time to join us, Hennessy Fund's portfolio manager.
Thank you very much.
Coming up, keep it right here on Yahoo Finance. We've got the countdown to the opening bell on Wall Street. We'll be right back.
And that is your opening bell on Wall Street. Let's do a check of the market. Still seeing pressure on the major averages, on track for the third day of declines here, especially when you look at the S&P 500 down over 1%, but the Nasdaq nearing declines of 1.5% as we hear that opening bell on Wall Street. Tech certainly leading this sell-off, though when you look at markets on an equal weight basis, you're also seeing a lot of the weakness coming in on healthcare and financials, some of the sectors, particularly when you look at financials, that have really seen a huge run-up following the election of Donald Trump for his second time in the White House, seeing a little bit of steam coming off of that trade here. And also just want to quickly mention the moves that we are seeing in Treasuries, still seeing a little bit of a move to the downside in yields at the longer end of the curve today, and that potentially could be an interesting dynamic for stocks moving forward here.
Certainly. And let's talk about how far we have come really over the last 12 months. Let's take a look at some of the biggest movers and decliners of the year. Let's start with the sector action and some of the action that we're seeing there. When you take a look at the outperformers there, many of the names that you just talked about there, Maddie, you got communication services, technology, consumer discretionary, financials among the outperformers of that group. A lot of that group seeing a bit of a rotation out of those trades here as we do close out the trading year and the year, obviously, for 2024, looking ahead to 2025. When you take a look at the top S&P performers for the year, a lot of those names that we have talked so many times about here on Yahoo Finance, you got a name like Palantir, that stock up just around 350% from the start of the year. You got Vistra Corp also among the top performers. Nvidia, when you talk about the outperformance of the Mag 7 trade, that stock up pretty substantially here on a year-to-date basis. You're looking at gains of just nearly 180%, around 177%. On the flip side, some of those worst performers if we can pull that up on the screen, you got Walgreens, Moderna, Intel among those decliners there. But again, it has been another record year for the S&P. You've got the S&P 500 here closing at record highs 57 times. And Maddie, when you compare that to historical numbers here, it's among the top 5 years that we have seen the S&P reach that high of record highs here during the year of 2024.
It's really interesting when you look at those best performing stocks that you already ran through, Shauna. There's not this massive concentration in tech specifically. Obviously, tech is in there. You've got Nvidia as the second biggest gainer year to date, but you've also got a lot of nuclear plays. You mentioned Vistra Energy, also Constellation Energy, among the names that those hyperscalers are looking at partnerships with as they do look for some form of energy to meet the demands of the AI boom. We're certainly seeing that with the 3 Mile Island deal over the course of this year. Then you've got United Airlines, the fourth biggest gainer of the year in there. Obviously, Broadcom considered now maybe the 8th member of the Mag 7 as the Batman acronym takes hold here. So really interesting to see kind of the rotation that we see even within tech and the drivers of that trade moving forward.
Yeah, especially, and I think that really gets to the conversation of what exactly next year is going to look like. When you take a look at, there's still, I think overall you can say strategists are very bullish just about the returns that we are going to get next year, especially on the heels of what have been 2 record-setting years. But again, when you take into account that maybe the gains won't be to the extent of what we've seen over the last 2 years, and that we could potentially see, and there's an expectation that we will see a further broadening out of this market participation, then exactly what that holds for the Mag 7, of course, is a huge question going into the new year.
And how much of that is relying on the Fed, too, which is, I know you've been asking guests this, just whether or not we need rates to come in order for that small and mid-cap trade to really pick up will be certainly something we will be covering for you here at Yahoo Finance. But now it is time for some of today's trending tickers. You can scan that QR code below to track the best and worst performing stocks of the session with the Yahoo Finance trending tickers page. First up here, American Airlines getting an upgrade at Raymond James to outperform from market perform with a $24 price target. The analyst behind the call saying American is among the best positioned names heading into earnings here. Also mentioning, though, a couple of other names here. You've got the likes of JetBlue, for example, Alaska, Allegiant, JetBlue and American best position heading into earnings, but on a long-term Delta, still this analyst top pick. It's interesting because this does come after an improved revenue outlook from American was issued in early December, but the street is still relatively mixed on this. About 38% of the street has a buy, but over half still have a hold on American. So it'll be interesting to see whether or not they can kind of rebuff any of those analysts with a hold rating in the upcoming earnings season here.
Yeah, exactly. When you take a look at the expectations for stronger profit, you take a look at the expectations for a very healthy holiday travel season. Obviously, that is 2 things that won't necessarily just benefit American Airlines. And you take a look at this call out from Raymond James, Savi Saith, the analyst there, also went on to say that this earnings season, Alaska, Allegiant, JetBlue are also, as well as American, are among those best positioned, at least in her view, on a medium to long-term basis. What's interesting here, and Delta remains a top pick, which is important to point out, just given the outperformance that we have seen in Delta most recently. But again, it's not doing enough in order to boost the stock today. I don't think necessarily a huge surprise, just given the fact that we have seen some gains here recently. But again, it basically boils down to three things. You got the improved revenue outlook, you've got the attractive competitive capacity set up, and then going forward, just anecdotal evidence of improved engagement with corporate customers. That's something we've heard from a number of airline executives here on Yahoo Finance over the last several months. So again, that coming into play and seen as a real catalyst here for the stock in 2025.
Absolutely. Certainly something that we're seeing across the airline space, just that demand in travel, especially amongst those higher paying consumers as well. All
right, let's take a look at Nissan. Nissan shares are sliding today, dropping about 13% over the past 2 days on concerns around the company's planned deal for Honda. Now, investors fear that Nissan shareholders will get a lower stake in the joint holding company. You're looking at losses of just about 5.7%. Lots of talk about how exactly this is going to play out, what ultimately this means, whether or not it is a smart deal moving forward. But again, you're looking at Nissan shares under just a bit of pressure here today. Again, a continuation of some of the drop that we saw going back to last week when there were some concerns about this deal and the likelihood that we will see this actually come to fruition.
Well, it's interesting to see this move to the downside off the back of reports that we're getting out of Nikkei, a financial outlet over in Asia, talking about the fact that we could see a 5-to-1 share transfer ratio in any merge to come. That would mean that Nissan investors in particular would perhaps end up with less shares off the back of this deal here. And the Honda market value is trading at about 4 times that of Nissan. So Nissan investors perhaps shaken up about these concerns about that share transfer ratio moving forward here. Interesting, though, to see kind of how this is going to develop, given that investors were clearly happy about the likes of this deal potentially happening. Will that be enough to outrun any potential concerns about that share transfer ratio?
Yeah, and I think just given that, then it's very vulnerable to some of this profit taking that we've been talking about, too. So contributing maybe to some of the declines that we've seen over the last 2 sessions. We want to bring you an update on the plane crash in South Korea that killed 179 people and marked the deadliest crash in the country's history. Now, South Korea officials have ordered an inspection of all Boeing 737-800 plane models. Possible bird strike and an unusual landing gear failure are the main points of focus. Investigators are preparing to analyze the flight recorders for clues on South Korea's worst civil aviation accident. Shares of Boeing declining as much as 5% this morning. You're now looking at shares off just about 4.5%. We got much more coming up ahead on Morning Brief.
It's time now for our chart of the day, and just 10 stocks account for 59% of the S&P 500's gains since those lows in October of 2022. And the reason we wanted to zoom out a little bit and not just look year to date is because the tech concentration has actually improved a little bit. As Shauna and I were just speaking about here, the year to date top 10 performing stocks, not all tech, right? But if you zoom out to those October 2022 lows, you see the overwhelming majority of these top 10 stocks are tech names, the like of Nvidia, Broadcom, SMCI is up there. Nvidia, by the way, up over 1,000% in that time period. So it's interesting when you talk about the concentration challenge and the idea that if the tech names aren't gaining, which is part of what we're seeing lead to declines today, it puts a lot of pressure on the market because it is market cap weighted to those tech heavy names. The challenge being moving forward, can we eke out gains if we don't continue to see that breadth coming in? And that is the key question moving forward, especially when you have earnings estimates so record high for those tech names. What is that going to mean for the year moving forward? How long can the party go on for the Mag 7, especially as you have yields continuing to move to the upside here, that also adding a little bit of pressure on equities. And then, of course, you also have the dollar having record strength heading into 2025. It's going to be really interesting to see January in particular. We know that as goes January, so goes the year, according to the Stock Traders Almanac, if you're looking at the technicals. So we will see what happens with the Mag 7 in January as potentially an indication of whether or not that stock concentration will continue to lead to more gains for stocks or in markets more broadly, or if it could potentially spell bad news for stocks heading into 2025.
All right, let's talk about that and more, Maddie. It's time now for today's strategy session. A tech sell-off on Friday weakened some of those hopes for a Santa Claus rally. Our next guest, though, saying that the death of the Mag 7 trade has been greatly exaggerated. We want to bring in Lou Bassanese. He is MDB Capital's president and chief market strategist. Lou, it's great to have you back here.
Good to be back.
On set with us. So talk to us then about maybe what's more realistic in your view about how this is going to play out.
Yeah, I think you're going to see tech continue to dominate. I mean, I was on the record last year saying that I didn't expect Nvidia to have another banner year, and it did. And I think that was built on the strength of spending on AI, right? We're seeing that coming from all the Mag 7 names. Tech, if you look, it touches every aspect of life. I challenge anyone to spend a moment today that doesn't involve tech. So it's going to be that bias. I think what gives me solace in this, the heavy concentration, is the fact that if we look at the other 493 stocks in the S&P 500, expectations are for their growth in earnings to accelerate significantly. So from about 4% this year to 13%. So we need other names to pick up and carry the ball in 2025, and I think we're going to see that happen. The tech sector is obviously going to have the strongest growth, but we need to see everyone else participating. So again, it's that potential. The estimates are there as long as these companies can execute and deliver. I think you'll see the market stage another strong rally in 2025. I mean, if we think back in the middle of last year, everyone was saying that the S&P 500 was going to be stuck in the mud and not go anywhere, and here we are at the end of the year, up 26, 27%. I don't think that's in the cards. But a solid, 15% earnings growth should drive the market up, close to double digits.
On earnings estimates, we are already seeing them revised to the upside for some of these tech names. But I wonder if that becomes an Achilles heel moving forward as well. Because for Nvidia, for example, we know profit growth estimates are declining. They're still moving up, but they're slowing. Yeah,
it's slower growth, but still growth nonetheless, right? I think that becomes, we talked about this maybe a little bit in the beginning of last year, had Nvidia gotten way too ahead of itself, right? The expectations, that tends to happen. I think you see a reckoning of that when we deal with the Fed, right? If the Fed stays on the sidelines, which I think is becoming more and more likely, there's gonna be a lot more focus on, is that earnings growth accelerating? Is it sustainable, right? Because once you get the earnings report, now analysts are gonna move to, all right, what's next? Can you keep growing 40, 50, 60% at a clip? I think that's when you have to start worrying. In the Mag 7, you have to rotate, I think. If you look at it now, the most undervalued name there is Google or Alphabet, right? If we looked 6 months ago, it was Apple, right? It was trending down to like 160. Everyone said they were going to miss out on AI, and then lo and behold, look what happened, right? So you see a rotation in the Mag 7. I think you want to be opportunistic there. So if Nvidia misses expectations, sells off, could be a good buying opportunity in 2025, but right now it looks like that Alphabet's trading at the most attractive relative valuation.
Well, what does the overall upside look like then for the markets in 2025?
Yeah, for me, it's hard. I mean, I'm not an indexer. I'm a stock picker, right? So I look at this. Is it bad to diversify an index? No, but you're probably limiting your upside to maybe 8 to 10%, like the averages, especially going in after 2 years of 20% plus gains. The earlier guest was talking, like, is it time to be a stock picker? If you're not a stock picker, then you got to look at the mid caps, small caps, maybe some biotech sectors, areas where there's value still in the market versus these, stretched valuations. I know there's a chart circulating now about forward PE ratios and then forward 10-year returns, right? So when we're at the current levels, the forward returns are 0 to negative for the next 10 years. So if I'm just an asset allocator, I'm not looking forward to that. I'd have to look maybe internationally. They're starting to look cheap. But yeah, I don't think we're going to get a repeat of the last 2 years in 2025.
And it's hard with the valuations call because valuation doesn't help you know exactly when you're at the top, right? So what do you look at for timing?
I think for me, I look into the speculative areas of the market, right? Like the peak in the dot-com days was 40 to 80 times earnings, right? So we're not near that yet, but at the same time, you saw every other speculative asset rallying. So look across the market. Are small caps at historic highs and really frothy? No. Are biotechs at historic highs and frothy? No. Is Bitcoin pulling back? Yes. I mean, for me, that's the greed index in this market. You balance that with the fear index and the VIX, and I think you just haven't seen that yet. So if I see VIX spiking, Bitcoin breaking, 150,000, small caps and biotech mergers and acquisitions popping up everywhere, I'm going to start saying that looks a little frothy, and you have to be careful. But again, the markets can stay irrational a lot longer than we can stay solvent, as the saying goes. So those rallies tend to continue a lot longer than we think.
Lou, when you take a look at some of the risk assets and maybe the appetite here for risk heading into 2025, what does the deal pipeline look like? How optimistic are you about IPOs?
I'm super optimistic, and I have a different perspective in that we're an investment bank, but we deal in the earlier venture stage opportunities, and I can say unequivocally, we're seeing more and more opportunities at really compelling valuations that have a lot of headroom. So these aren't just niche products. These are potentially life-changing drugs that could cure diabetes, AI applications that could really make in the palm of your hands for a practitioner or a clinician that has a patient that's diagnosed with cancer in the middle of America, put at their fingertips the latest clinical study. So things that have tremendous upside, and there's now, more importantly, there's an appetite from our investors now. I think the election had this big overhang of uncertainty. Like everyone just wanted to find out who is it, either one way or the other. That anxiety is gone now, so everyone's being very, very opportunistic. So I know from the bulge bracket banks, they're talking about a resurgence in M&A and IPO activity. I can tell on the even riskiest side of that we're seeing that as well from our deal pipeline.
And we're 2 weeks out from those bank earnings, so we'll be able to get a lot more insight into some of that activity soon as well, Lou.
Yeah, absolutely.
All right, well, thank you so much for joining us. Really
Thank you.
appreciate it. Thanks for coming in studio as well. Coming up, Netflix has had a banner year, but we're going to speak to an analyst who sees even more room to run for the streamer next. Stick around for more on Morning Brief.
Netflix has seen massive gains this year, up 86%, outperforming the S&P, far outperforming the S&P 500. Our next guest just boosted his price target on the stock to $1,000, saying that there are several reasons the streamers can continue to outperform the S&P into 2025, but there is some caution ahead. He's still cautious that Netflix could be approaching a valuation danger zone. Let's start there. We want to bring in Justin Patterson. He is a managing director at KeyBank. And Justin, you talk about a valuation danger zone. What do investors need to know?
Yeah, great. Thanks for having me. So if you look at Netflix's valuation right now on an EV to sales basis, it's right around 9 times forward sales. And historically speaking, that's a top for the stock. But we step back and dive a little bit deeper here. This is a business that's showing a free cash flow inflection, which it didn't have in the past. And it's now shifting toward more of a monetization story in there. So as you see content like Squid Game 2, the NFL that just recently happened, WWE, which kicks off January 6th, and then Stranger Things 2 Stranger Things Season 5, hitting this coming year, that's going to drive more time spent on the platform and support price increases over time. So when we see that and then flip over to an earnings multiple, the stock's trading in 2026 at a high 20s multiple. That looks pretty reasonable to us for a stock that should be growing north of 20% on earnings for the next few years.
How did the live event that was the Christmas Day double game special play into your call, Justin, if at all? Did that make you more bullish on the stock?
You know, we've been expecting a big number from that, just from the Jake Paul, Mike Tyson fight previously. Looked in line with expectations. What I'm more interested about on the go-forward basis is just the NFL setting up more live events in the future. So we've already had an announcement on Women's World Cup coming to Netflix over the next few years. I think as you go through the course of 2025, there should be more live event announcements from Netflix. And as you get more of these big events that draw a lot of eyeballs, that's good for new subs growing, and it's good for advertisers coming on the platform. And that really gives you more confidence in the 2026 and beyond story here. The interesting thing about Netflix so far, a lot of this growth in 2025 or 2024 and into the start of 2025 is more sub-based, so more members joining the site. We still haven't really had that monetization inflection yet, either from pricing or advertising getting bigger. So as we see that play out over the course of 25 and into 2026, that makes Netflix one of the few stocks in our coverage universe that could actually have revenue re-accelerating to exit 25. So that makes for a pretty compelling growth profile here.
You know, just I'm curious, when you talk about streamers and you talk about the space in general, there's been so much focus on consolidation and what that looks like. We know Netflix has very much brushed off any rumors or any consideration. You just had Ted Sarandos speaking at the UBS media conference earlier this month, reiterating that the company doesn't have any plans to pursue M&A. Is that the right strategy, do you think, for Netflix? Or should this be something that the company does pursue in order to maintain that dominance?
You know, historically speaking, Netflix not acquiring other companies has worked out quite well for the business over, this year or even longer time periods. It's been a very, very attractive investment to go back into the core business, invest in content, as opposed to acquiring other businesses and taking on M&A risk. So I don't think anything necessarily changes there into 2025 and beyond. I think the ability to just go out, license unique sets of content, or be opportunistic on some of these live events like the NFL, like World Cup, provides enough of a lift to the core business here.
And you lay out such great points in the note about how Netflix has already won, and you think this time is different in terms of more room for upside off the back of that win. But what names in the streaming space do you think could potentially disrupt that win for Netflix? Who else should investors be looking at?
You know, I only cover internet media stocks in there, so I'll defer the traditional media to some of my peers, like Brandon Nispel at KeyBank. I think the only other place I would recommend looking at would be just adjacent to Netflix on the audio side. Spotify has been one of our top picks for the past 2 years now. Still has a lot of runway in terms of gaining more music listeners around the world. You're starting to see pricing become more of a driver for the business. And similar to Netflix, there's now a lot more partnerships on advertising to make that a bigger piece of the story into 2025 and beyond.
All right, Justin, thank you so much for joining us. We appreciate it.
Thank you.
That's going to do it for the Morning Brief. You can join me and my co-host Shauna Smith again in the next hour for more analysis right here on Catalyst. Stick around.
Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. We are 30 minutes into the U.S. trading day. Let's get you the 3 catalysts that we are watching this hour.
First up, we break down the final trades to watch as the final week of trading kicks off with U.S. stocks trading in the red.
Plus, we push ahead to the end of the week as the House prepares to vote on its next speaker and potential chaos that it could ignite.
And we look at the life and legacy of former President Jimmy Carter and specifically the impact he had on energy policy. All that and more coming up here on Catalysts.
Let's take a look at some of the market headlines to start the hour. This is sponsored by TC Trade. We're just 30 minutes into the trading day. You got the 3 major averages up on your screen, and you can see the selling that we saw on Friday continuing here this Monday morning. You've got the Nasdaq leading those declines. The tech sector, or the tech-heavy Nasdaq there, off nearly 2%. You've got the S&P off just around 1.5%. The Dow also off just around 675, right around the lows of the session. A bit of a rotation out of some of the trades that have been working for the majority of the year. When you take a look at the fact that the Nasdaq is leading those declines lower, that very much tells you that we're seeing some of that increase as selling pressure here in a handful of those tech names that have really been responsible for so much of the momentum that we've seen over the last 12, 18 to 24 months really within the market. So again, not necessarily a surprise given the fact that we did to some extent expect some profit taking given the year-to-date gains that we have seen. Let's flip over to the bond market. We talk a lot about the increase that we have seen in treasury yields. We're seeing a bit of a give back here this morning. You still got to have the 10-year yield right around that 455 level, but off about 7 basis points here this morning. And taking a look at Bitcoin, after reaching a record high, you're seeing some of that selling continue here, holding above 91,000, but again, off another 3% here this morning. Risk on asset has very much seen a rally, to say the least, since President-elect Trump was elected back in November. We've seen it skyrocket here almost to the moon, this straight arrow to the upside here. We're seeing a bit of a give back here once again this morning. So we'll see whether or not that 91,000 level holds.
Absolutely. That's certainly what's going on Wall Street. But we're going to move over to Washington. We could be headed for another House Speaker showdown. The vote for the speakership is scheduled for this Friday, January 3rd. It's unclear whether current Speaker Mike Johnson will hold his position. House Oversight Committee Chair James Comer saying on Fox News this weekend that he strongly urges President-elect Donald Trump to convince any holdouts to vote for Johnson. Here with more, we've got our very own Rick Newman joining us. Rick, it's a really slim margin here. Johnson can only afford to lose 1 vote among Republicans to keep his speakership. Does he have the votes?
Not clear. And for anybody wondering what the heck is going on here, all you have to do is just go back to when Republicans had the very same battle in 2023. I think it was September of 2023 when they dumped Kevin McCarthy. And the issue is going to be the same thing all over again. There's this small group of what you might call super conservative budget hawks who want to see an axe taken to the federal spending. And they might oppose Johnson because he's not giving them what they want. So, the Republicans sound like one party. I mean, it is the Republican Party, but it really is split into factions. And it's not at all clear that even though Republicans are going to control the White House and both chambers of Congress when Trump takes office, that Trump is going to be able to control enough Republicans in the House to get what he wants. So this is going to be the first test, is whether Republicans can reelect Mike Johnson as Speaker. And if they don't, again, it's going to be a replay of what we saw in 2023 with one new candidate will come, then another new candidate will come, and it's going to be a question of who can make the promises to persuade a small number of super conservative Republicans to vote for a Speaker.
And as as you were speaking right there, Rick, you had President-elect Trump coming out saying that Mike Johnson is a good, hardworking, religious man. Mike Johnson has my complete and total endorsement, and I know you and all of us are going to be closely monitoring how this all plays.
That might not be enough to do it.
Yeah,
that in itself is not enough.
Rick, I also want to get your take while we have you on the passing of former President Jimmy Carter, particularly focusing in, we talk so much about his overall influence, especially some of the work that he's done post-White House. We talked about his battle with inflation while in the White House, but we want to zero in on the energy sector and some of the energy policies. I'm curious just how you think his policies have influenced, have helped shaped some of the modern energy strategies that we have today.
If you go back to the 1970s, it was a completely different time in the United States with regard to energy. America was not energy independent as it is today. It was very reliant on oil from the Middle East. And when Jimmy Carter won election in 1976, that was just a couple years after the 1973 Arab oil embargo. That's when we had gas lines, gasoline prices skyrocketed. We had rationing. So Jimmy Carter wanted to take steps to make the United States more energy independent. He called for the creation of an energy department, for example, to coordinate U.S. energy policy, which was just scattered throughout a bunch of different federal agencies at the time. He did get that. So he signed legislation that created the Energy Department in 1977. He pushed for more U.S. energy development, including fossil fuels and renewables. I mean, renewables were just getting started at the time, and there was not the kind of efficiency we have today. But he did do things to establish more U.S. energy development. The thing that really made the United States energy independent was the development of new fracking technology, which came online way after Jimmy Carter, around 2005, 6, 2008, 2009. But Jimmy Carter kind of got the ball rolling. And I think he must have been very happy to see the kind of all of the above energy policies that we began to develop in the 2010s, which is what he called for all the way back in the 1970s.
It certainly was ahead of his time. Rick, thank you so much for breaking that down for us. I really appreciate it.
See you guys.
We also have some news crossing the wires right now. The New York Stock Exchange and the Nasdaq will be closed on January 9th to honor former President Jimmy Carter. There will be no stock trading on those indices on January 9th as the U.S. holds a national day of mourning. Got much more of today's market action ahead. Stay tuned. You're watching Catalysts. Pending home sales crossing the wire, rising 2.2% on a month-over-month basis in the month of November. Giving it a little bit more context, we've actually seen the index now reach its highest level that we've seen since February of 2023. And breaking it down on a regional basis, you've got Northeast that actually declined 1.3% on a month-over-month basis. But in the Midwest, the South, and the West all saw month-over-month gains. You have the Midwest up 0.4%, the West up 0.5%. The South is where we saw the biggest increase in activity versus October, where we saw month-over-month a jump of just around 5.2%. Why is this significant? Pending home sales often looked at as a leading indicator of existing home purchases. We know existing home sales, Maddie, have very much remained depressed, I think is still safe to say overall, given the fact that we have very high mortgage rates, the fact that home prices remaining extremely high here. Obviously, the affordability factor has been a huge issue, has been keeping people sidelined here. So if we do see a little bit more activity in the pending home sales number, then maybe it is an indication that we will then see that translate over into existing home sales.
And it's a great kind of context to provide the idea that it is that leading indicator for the market, but also this idea from Lawrence Yun, the NAR chief economist, from the print, saying consumers appear to have recalibrated expectations regarding mortgage rates and are taking advantage of more available inventory. So basically, it sounds to me like they're saying buyers are no longer willing to wait for rates to come down, which is probably smart given the activity that we're seeing in the longer end of the yield curve. We're not seeing much relief there. So if you have been wanting to buy a home and you've been waiting for rates to come down, perhaps you're thinking, I'm just going to go ahead and get that home, regardless of what's going to happen with the Fed, because it has been so difficult to parse what the Fed is going to do moving forward. And perhaps that's one of the potential explanations for why we did see that move upward of 2.2% in November. Again, the fourth straight month of increases there. Let's turn now to the small cap trade. A lot of talk among strategists this year about the potential rotation into small caps as the Fed was set to begin their rate cutting cycle. We even saw the Russell 2000 briefly outperforming the S&P 500 in August. Small caps got a boost after President-elect Donald Trump won in November as well. So what can we expect from the trade in the new year? Joining us to discuss, we've got Brian Vendig. He is the Chief Investment Officer at MJP Wealth Advisors. Brian, great to have you on here. This small cap trade, we have been waiting and waiting and waiting for the catch up in these small cap names. Is 2025 going to finally be the year?
Great to see you, Madison. Good morning. I really hope so, because when we think about the policy decisions that are out there in the future, they're there to support the economy and also the Fed still keeping the door open for rate cuts. And I think in the short term, those policy puzzle pieces has definitely cast a doubt on the small cap trade, recognizing that this past month has actually been, I think, the worst month on record going back to the fall of 22. But when you look at small caps over the last 10 years and that significant underperformance as compared to large cap peers, I still think it's something that investors should think about from a diversification point of view. And also considering that when Trump won back in November, we saw a huge boost to the small cap market. It didn't take much to catalyze the sector. So our view is that as long as the economy stays on stable footing and some of these policy decisions don't go to extremes, and obviously a little cooperation from the Fed, that could be the perfect combination to see small cap outperformance in 2025.
So Brian, when you talk about the policies, it's important for policies not to go to the extremes. It's important for the Fed to cooperate just a bit. I guess more specifically, what does that look like?
Yeah, Shauna, so that's a great point. So just to drill in, I mean, right now when you look at the bond market, for example, it has priced in that there will be 0 rate cuts next year. And I recognize that since December 18th, we've seen this pullback in the market due to Fed speech and also from the realization that with Trump 2.0 coming to town, we don't know what's going to happen with the extent of immigration reforms. We don't know exactly how Congress is going to behave regarding tax policy changes or maintaining the existing 2018 tax cuts past the end of 2025. And we also don't know the extent of restraint that might exist with fiscal spending, which is supportive of the economy in the short term. So those types of puzzle pieces, Shauna, is what's casting down and why we're seeing the market pulling back, I think, towards the second half of December. Also, the Fed adding a little catalyst to that uncertainty regarding policy measures. But at the end of the day, just to crystallize all that, I think the market's going to come back to earnings. So first couple of months next year, first half of next year, easy to say choppy market. due to those policy issues. But if earnings continues to stay intact, earnings growth year over year, 10% growth there, we're still constructive on stocks. And we also think bonds might be an opportunity as well, considering where yields have come so fast, so quick since the last couple months of the year.
So what trade does that initiate, those puzzle pieces? Some of the sources we've spoken with have said that could lead to more of a rush into tech as a safe haven, but others say that tech becomes even more risky in that backdrop. What do you think?
Well, Madison, I'm definitely at the point where when you consider how much tech is a big part of the market cap weighted indices these days and where investors have gravitated to, I'm definitely not one to recommend to add to mega cap tech at this point. But I think taking a look at some of those value-oriented sectors that help to play into innovation and growth for the economy still makes sense. And so areas such as the industrial sector, when you're thinking about innovation around infrastructure, electric grid enhancement, power generation, but also like innovation in the biotech area and also some of the large pharma space as well to play a little offense and defense. And as I said before, if you look at things from a valuation and a forward-looking perspective, mid-cap and small-cap stocks are more fairly attractive than large, and we're still allocated there accordingly. But I think you really need to come back to that point of broad diversification in this type of market environment and making sure that you're not overpaying for growth from some of the winners of this past year is what really makes a lot of sense as we move into next year. And as much as bonds have gotten beaten up in the short term, I think investors have a chance to look at those bond yields and say, hey, well, those are a little higher than just traditional cash money market than when we were before. And if we get a little bit of a pause in the economy or we get some uncertainty, we've seen normalization of behavior of investors going back and buying into fixed income. And I think that might be an opportunity for investors as well over the next 12 months.
Brian, we just had pending home sales numbers out this morning showing an uptick here on a month-over-month basis. When you compare that to year-over-year basis, there seems to be some optimism within the release, just talking about some of the activity that we could see within the housing sector, pairing that with the housing starts number that we got not too long ago, where we did see a bit of a move here to the upside. Is that an attractive investment opportunity? Why or why not? And where should investors be looking?
Well, I definitely think there's areas, Sean, as you mentioned, where housing could be an attractive sector if you get a cooperation on Fed policy regarding rates. At the same point in time, I think when you look at the labor market and you look at the stability of the labor market, even though the labor market might show some signs of slowing next year, Americans feel comfortable in spending and looking at some of these bigger ticket items when they feel confident that they have a job. And I think, when it comes to housing, infrastructure, some of these cyclical oriented sectors, they're having a little bit of a tough time over the sense of this quarter due to those policy uncertainties. But I think as more and more information comes out from our friends in Washington and also the Fed, I think these might be opportunities for upside potential over the balance of the second half of next year.
All right, Brian, thanks so much for taking the time to join us here this morning.
Thank you.
Coming up, we are talking to a crypto CEO who sees big changes ahead in 2025. More on that coming up after the break. Crypto had an eventful 2024. Bitcoin finally reaching $100,000 mark. And we also had David Sachs' appointment as the first AI and crypto czar, just to name a few. So as we head into the new year, let's talk about some of those top crypto themes to watch for in 2025. For that, we want to bring in Alexander Bloom. He's the CEO of 2Prime. Alexander, it's great to have you here on Yahoo Finance. You were recently out with 10 crypto predictions for 2025. We want to zero in on 3 of those that we think could have the biggest impact on the price of Bitcoin here moving forward. And that first thing that you pointed out was that the U.S. is going to declare Bitcoin a strategic reserve asset. I guess 2-part question here. 1, how realistic do you think that is? And then 2, how much of that optimism has already been baked into the price of Bitcoin here today?
Yeah, so thanks for having me on. I would say, first of all, in the light of the last year with Bitcoin ETFs being extremely successful, the most successful ETFs ever created, as well as the election of pro-crypto candidates and a pro-crypto administration, the backdrop is set for a strong 2025. In terms of your actual question, there's 2 aspects to the strategic reserve. One is, by executive order, Trump can take the Bitcoin that the U.S. government has confiscated and already owns and just say, this is part of our strategic reserve now. There's about 200,000 Bitcoin that the U.S. government already holds. In addition to that, which is maybe a bit more complicated, is there's a bill in the Senate introduced by Cynthia Lummis to buy another 1 million Bitcoin through the Treasury. That is a little bit trickier because it has to go through the whole legislative process and can't just be done with the swoop of a pen. However, I think, if you look at the kind of pros and cons of being pro-crypto, if you support crypto, you get more votes, you get more political donations, and there's really not a lot of benefit to being anti-crypto unless you're completely bought by the banks. And so I think there may be the political will to actually approve that bill as well. We've also seen, it's also significant, not just the U.S. doing it, but it'll set a tone for other countries to follow suit, just as other countries have collected gold in the past.
Yeah, talk to me about that part of your call, Alexander, the idea of other global central banks scooping up Bitcoin, especially in relation to the strength we're seeing in the U.S. dollar. Can other central banks really afford to be hedging with an asset like crypto and Bitcoin?
I think, well, first of all, central banks can print paper money out whenever they want. And if they're buying a real asset with it, it's better than what they spend most of their money on, which is typically poor spending. And so I think central banks definitely can do it. It's a question of who has the incentive and kind of political will to do that. And I think there's 2 categories of groups that have that interest. There's one is people trying to get out of a dollar reserve asset. So maybe a country like Russia that has incentive to not be stuck to the petrodollar. And then there are countries that are trying to keep up with the US. So countries maybe like China or England that, if the US is doing it, even if there's just the US doing it makes the odds of it being a successful asset even greater. And so the game theory is, well, I want to keep up with the United States, and their involvement makes everything more likely to be make this an important asset. And so I think it's a very real thing, and central banks can definitely do it.
All right, Alexander, we have less than a minute here, but the third point that you bring out is that we might see a bit of a follow here in MicroStrategy's lead with a FANG company adding Bitcoin to its balance sheet. What signal is this going to then send to the markets, and who, I guess, of the FANG members?
Yes, so, by my calculations, these companies are sitting on about $383 billion in cash at the moment. Even a small percentage of that put into Bitcoin would likely benefit the shareholders a lot more than the cost of the actual purchase. I think the more forward-facing ones that have already expressed some interest in crypto, like Meta in the past, might be good candidates for it, especially ones that already have a lot of founder-controlled shares that they can use their kind of decision-making to make these decisions more utterly.
All right, we got to leave it there, Alexander. Thank you so much.
Thank you.
Coming up, we'll have much more ahead on Yahoo Finance. Tune in at 11 a.m. Eastern Time for Wealth, dedicated to all of your personal finance needs. And stick around for more.
Welcome to Opening Bid. I'm Yahoo Finance Executive Editor Brian Sozzi. To close out 2024, like many of you, we've been reflecting on the year we've had while also eyeing a holiday self-purchase or three. May I recommend a one-year subscription to Yahoo Finance Premium for a loved one? Anywho, we have had endless amazing guests who brought us top investing insights, big tech predictions, big stock calls, and in-depth market outlooks. Shout out EMJ Capital founder Eric Jackson for his hugely right call on AI darling Nvidia. And though all of our guests are amazing, I want to bring you a few of my favorite comments of the year, a Sozzi special, if you will. First up, with incredible humanitarian work around the globe, Howard Buffett needs little introduction. We cover many topics like his work helping farmers in Ukraine, as well as the legacy of his father, Warren Buffett's Berkshire Hathaway. Take a listen.
You're the next chairman at some point, whenever that might be, of Berkshire Hathaway. Let's assume that happens. How does your life change? Of course, you've been on the board for some time of Berkshire, but how does your day-to-day change from what it might be now?
Well, it changes a lot in terms of probably where I travel to begin with, because I travel internationally all the time. I've been to 154, 155 countries or something, and I'm on the road a lot. I've been in Ukraine 5 times in 2022, and same thing 5 times in 2023, and probably 4 or 5 times this year. So, those are trips I won't make. And I've been in Colombia this year. Those are trips I won't make. I will need to keep in mind that I need to be around to do my job and my responsibility. So I think, the risk level of what I do in my life today probably gets decreased. If you look at what I've done throughout my life, every 7 to 10 years, I've kind of recreated what career I'm in. I mean, because I'm curious, I want to learn new things, and I love doing new things. And so, when the time comes, my life will change some, and I won't be running the company. I was a non-executive chairman, so my job will be support Greg in every way that I can. But I won't. I will change some of what I do out of the fact that both my brother and sister and I will have a huge charitable trust that we're responsible for, and also my sister and I being on the Berkshire board will have that responsibility. So I think I refocus a little bit. Maybe that's the way to put it.
I think it's been said that you will be the guardian of Berkshire's culture. For the people that haven't seen it from your perspective, what is that culture like? Why does Berkshire just work?
Well, I mean, it's interesting because my dad's a lot more simple in terms of the kind of person he is, what he does. I mean, he's very sophisticated in terms of business. Don't get me wrong, but he's none of us own yachts. None of us have, vacation houses in France. None of us have, I didn't grow up that way. That isn't how he lives. So, it's really pretty simple. And so that the way he is personally just comes through in Berkshire. And so he is somebody who believes in integrity is number one. You treat people fairly. You don't do a deal with a bad guy because it's never going to turn out right. So you try to pick your partners selectively and be smart about it. And so, it's not complicated. I mean, it's really pretty simple.
No, you're being it's complicated. I mean,
Brian, people make things more complicated than they need to be. They really do. Yep. And Berkshire's got a great board. They got great management. Greg and Ajit are phenomenal. And so, it's a great company, and people can always find reasons they don't like a company or they don't like what management's doing. When I worked at ADM, I did something one time. And I thought I was going to probably get fired, but I had investor relations as one of my responsibilities, and I have to tell you, I didn't like it. But
it's not a fun job. It's not a fun job.
No,
who wants to talk to Wall Street? Nobody wants to talk to Wall Street.
No, but you have a lot of people who are mad at you all the time. So I had this guy call me who called me, I don't know how many times, every couple of weeks, and he was just mad about something, and ADM did this wrong and they did that wrong. And so I said to him, I said, look, just take today's price and I'll pay you a 10% premium, sell me your stock, I'll buy it personally, and then go buy something you like. So I never heard from him again. I never had to buy stock, but I went in and I told Dwayne what I did. He says, that's a great idea. And I said, yeah, the problem is I can't afford to do that with everybody that calls me. So I said, I need a bigger piggy bank. But, people, they sometimes they expect things that aren't reasonable. Sometimes they just get mad over things. People complicate things just by the nature of how they behave. And Berkshire's culture is pretty simple. You do what you say you're going to do, and you do it when you say you're going to do it, and you're honest about it. You make mistakes, and you accept responsibility for those mistakes. And I think anybody who runs a business like that, and there's plenty of businesses that are run like that. But that is, we try to run our foundation that way. It's really not that complicated.
Could Berkshire ever be replicated? I see so many young adults, they want to create the next great AI company or social media platform, but I don't know, why don't they try to take a page out of Warren Buffett and try to create something lasting and durable and with competitive advantages like a Berkshire? If I wanted to today, could I try to do something like that?
I think it'd be hard, but I don't, and I kind of follow the same rule in my personal life, which is, of how you just described it. I own a certain amount of stocks. I don't buy and trade. I probably haven't traded a stock for, years. If you can be reasonably smart about what you buy, and then you hold it and look at the appreciation that we've had in the stock market. And of course we'll have some adjustment at some point, and everybody gets nervous, and then it'll come back. But you're in a country that is really, we may not be in the top in every category if you go down and you look at things analytically, but in terms of the opportunity people have in this country to go out and be entrepreneurs, be innovators, take risks, that still exists today, just like it did 20 or 30 years ago. So, we live in an amazing country that way. We are in a scary period in terms of where we are politically, in terms of how polarized things are. But the economy continues to move on, and I think we're very fortunate to be in the country that we are in.
Next up is the race car loving Ford CEO Jim Farley. Big Jim clued us into the future of automobile technology, including EVs and AI. He even revealed that he texts with Tesla's billionaire founder Elon Musk. You all don't know, but I'm a huge car guy, so I just love speaking with Mr. Farley. Enjoy.
What is your view on where the car will be? In our lifetime, does a car drive by itself? I see what a company in China like Xpeng is doing, flying cars. To me, it looks like a helicopter, whatever the hell it is. What does the next 30 years look like for the actual physical thing that's a car?
I don't think really anyone with a lot of confidence can tell you what 30 years looks like. But it's pretty clear to us what the next 5 to 10 years look like. It's not going to be a future that's only EVs. It'll be a mixed powertrain of EREVs, PHEVs, hybrids, pure ICE, if you're towing something, and electrics. And electrics will be a big part of the industry, but not the only part of the industry. We're going to have a lot of software in our lives. The trips are going to change. The trips are not going to be from point A to point B with just bringing in your mobile device and kind of basically catching up with the rest of your life. Trips are going to be different now. With level 3 autonomy, where you're going to be able to take your eyes off the road on a sunny day on the highway in 2 years, people are going to do conference calls. They're going to do.
Can I talk to you? Will my car be able to talk to you? Like if you pass me by,
of course,
I'm like, that's Jim Farley in his Mustang.
But you would have to give it permission to share your data, but just like your phone. But absolutely, and that makes the whole transportation industry a lot safer if the cars can talk to each other. We have 1,500 semiconductors in the average Ford now, and it's the most technological product that I can think of. We have up 6 to 8 cameras in every car. We have radar systems. We'll have LiDAR systems. The cars are unbelievable, but they're also data capturing machines. It means we have to be really careful about people's privacy and about remotely controlling the vehicles, because they can be remotely controlled with autonomy. They can crash into things. There are a lot of dangers with the new digitally enabled products, and our policymakers have to catch up with that reality.
Are they even paying attention to it?
Yes, the U.S. government, the president issued an executive order a couple months ago. All aspects of the federal government are looking at, data privacy and autonomy and the policy around level 2 and level 3 autonomy. Forget about robo-taxis. There's a lot of exciting AV automated vehicle technology between robo-taxis and today that will be accessible to millions of people. We have over 26 million hours of Blue Cruise hands-free operation now. We have hundreds of thousands of people get up in the morning and press that button and drive hands-free now on highways. And we're starting to see the government engage in these important policy areas that will really have a big impact on people's daily lives.
Your counterpart at Tesla, Elon, views his company as an AI company. Is Ford an AI company?
I don't think we constrain ourselves that way. I mean, we're a passion company. We don't see our vehicles as appliances. They're not toasters on wheels.
No.
Or iPhones on wheels. Our vehicles do the daily work of building America through our Pro vehicles. The F-150 is the best-selling vehicle in the United States. And has been for 40 plus years because it's the most versatile product. We have an electric one, we have a hybrid one. The hybrid one can power your house for 6 days with Pro Power on board. And of course we have internal combustion F-150s. And with 2 rows of seating, you could practically live in an F-150. I'm sure someone out there is living in an F-150.
I'm sure they are.
So I think we have of course, our vehicles will be filled with AI, as they already are, to do Blue Cruise. But we don't limit ourselves that way. We want to build vehicles that people care about, that change the world, not just because they're efficient technology, but because they make people's lives better and because people care about them.
After the break, gold, whiskey, and Disney. What else could you need in life? Stay with us. Welcome back to our special Best of Opening Bid episode. Another one of my all-time favorites who I enjoy chatting with so much that we've welcomed her on the show twice, as well as the Yahoo Finance Invest Conference in November, economist Judy Shelton. She joined us before the presidential election with some very interesting commentary on the future of gold and, of course, Costco. Podcast. Gold prices have gone through the roof. I mean, I guess it's a Judy Shelton rally, right?
I think it's a rally, but it may have more to do with Costco stocking gold. It's a very trustworthy company. And I think it might reflect a collective yearning among consumers for real money. But it is a phenomenon. I think in the last year, it's probably up over 40%.
So we've talked in the past that, and you're a gold expert, you've spent a lot of your career studying gold, what drives it, what doesn't drive it. What does it say that that Costco, a retailer known for selling meat, bulk goods, is essentially selling about $300 million a month in physical gold bars? I mean, what is the economic read-through to someone that has studied gold for many years?
Well, when I've studied gold, it's been in the context of historical monetary systems and how economic performance is affected by the underlying monetary foundation. So I don't look at it as an investment, but as more a reflection. And I think that people have had a bit of a shock in the last 2 or 3 years, seeing real inflation getting up as high as 9%. But say since January of 2021, they've seen the dollar lose 20% of its purchasing power. And I think for some investors who buy at Costco, maybe they're just being savvy. I mean, they are making a profit. Other people might be very prudent. They're diversifying their portfolio. But I think it also is reflecting this yearning for real money. Gold is kind of a surrogate for the real economy. And it represents commodities, but also that traditional role of money you can trust. It's a meaningful unit of account. It works across borders. It has universal value, and it's highly recognized. It's a store of value. It doesn't mean gold is going to increase in its dollar value, but it probably does. And I think that it reminds people at one time, our own system was based on a specific weight of gold. So to say that today the dollar should be as good as gold is to say, let's learn from historic systems, because they did deliver some real benefits to people, including the right to convert at a pre-specified price your paper currency. That's what we're missing, is that accountability for our central bank, the Federal Reserve.
My view on gold is probably a lot simpler than yours. I was trained to view gold as one buys gold because they expect unrest at some future period of time. So I have that gold bar, and I may need to use it to buy a loaf of bread. I mean, from an economic standpoint, do you see trouble ahead in the economy that would warrant going out and buying gold?
Well, I think the same people who are concerned about a sudden breakdown in civil obedience, kind of an apocalyptic scenario, do know that gold is seen as a medium of exchange automatically. It has that traditional role. I would say in a less hysterical way. I mean, I'm not saying these things won't happen, but let's say if we have a basic positive outlook for the geopolitical situation, we might nevertheless see gold as that safe haven that I think you're referring to, because hopefully we don't have to buy a loaf of bread with it. But it is a mainstay. In that sense, it's an alternative currency, a real currency that fulfills those functions.
Next up, Salesforce co-founder, chairman, and CEO Mark Benioff shared his outlook on AI agents, specifically how they can make a difference at his favorite place on earth, Disney. Listen in for his comments from Dreamforce 2024.
I just think that this idea that you're going to be working with autonomous agents is a more powerful, thoughtful concept inside a platform. You know, it's not just about your customers working with these agents. In the example with Disney, it's their employees that they're delivering a magical guest.
Your favorite place.
Well, it's my favorite place, and it's a magical experience for their cast members or their employees. And I am the #1 Disney fanboy. I am. Mm-hmm. And I go to Disneyland all the time, and everybody should, maybe 4 times a year.
How do you find time for this stuff?
Brian,
I don't get it.
You're missing out on life.
I really am.
And then I get a Disney guide because I don't like to stand in the lines. Mm-hmm. And the Disney guides now use, through a little bit of my cajoling and nudging, Salesforce to keep track of all the customer information, and Slack to collaborate with each other in the park, because that's a very important part of Disney guides. Because what happens is, it's a theme park. Everything is not running all the time, of course. That's normal. Because safety is #1 for Disney, as it should be. And now my vision and my dream and what I'm trying to have happen, what I hope will happen, is that Salesforce will appear on his phone and go, hey, I need to tell you something. I know you're on tour with Mark. Mark has already seen all these rides and done all this. He's been here 4 times this year. You're on your way to Rise of Resistance, are you? Yes, but it's down right now. You need a new choice. And the cast member says, what should I do? And the agent says, Toontown, A+. And it knows that because it looked across all the parks, California Adventure, Epcot Center, everywhere, and then said, based on flow control, based on current size and safety requirements and getting Mark around and how fast he can walk, we recommend this ride for Mark, and plug him in. And there's no way that the cast member is going to be able to look across all rides and all flow and all consumers and make that choice. But where a human and an agent can work together, and that's my dream for Disney.
Bob Iger, hope you're watching here.
This is really amazing opportunity for Disney, and I love them. I will spend as much of my time working with them as I can. I have for more than 10 years.
Mark, I think I would be the guy. If I saw you in Disney, I would stop and ask you about agent force and profit margins. I mean, that's what my life has become at this stage. I just can't shake this stuff. I can't get out of my head. What surprised me, or what surprised me just taking this all in, is the speed at which all of this is developing. Does it feel like things are moving too fast?
No, I don't think things are moving too fast, but I do think a lot of customers are wasting their money trying to DIY it. Too many customers that I've met with personally are trying to DIY this next generation of AI. They're trying to take the model, the database, build a sharing model, build in security, hire a hyperscaler, and build all the framework and try to make it all work. And it reminds me a lot of the beginning of the industry when we started with the cloud, where I saw customers trying to do that with the cloud.
To close us out, a little on the nose for a holiday episode is our interview with Suntory CEO Tak Nianami. Here's his thoughts on the future of the alcohol industry as climate change continues.
And if you're thinking out 25 years from now, given what we're seeing with storm activity in the U.S., climate change, ocean levels rising, I mean, how is that going to change the business of alcohol? At the end of the day, to your point, you need water, you need clean water, you need access to these raw materials.
Well, first, because of the huge distortions, because we human beings emitted and still emitting lots of carbon, and that caused huge problems in the world. And whether it's so bad, and take a look at the lots of natural disasters. So we corporate as Suntory, we have to give back to society, like water conservancy, and we replenish water as much as we use, at least. And we educate the importance of natural water to children. So we do our best to do for the society, like to reserve nature and reserve forest, reserve water, and the biodiversity, like ocean pollution. And we are now working on recycling, which means we will change entire plastic bottles to sustainable plastic bottles.
That's hard to do with alcohol, right?
No, I mean, I'm talking about soft drink, but we use sometimes plastics. So that is causing lots of problems in ocean pollution, right? So we have to address social issues so that we can be appreciated by the community. And drinking is sometimes a huge criticism from society. But we are good citizens in society, and we are now promoting heavy drinking. Moderate drinking, that creates good bonding among people. So we are talking about that. And plus, we are talking that we are doing great thing to society as the corporate citizen. So that's what we've been doing, and we will promote furthermore.
This time last year, this vodcast didn't even exist, folks. But now nearly 100 episodes later, Opening Bid has grown tremendously because of the hard work of our amazing Yahoo Finance team. And most importantly, all of you, our amazing listeners and viewers. Thank you for staying with us, and thank you for the daily support. We really do greatly appreciate it. So like I always say here, this is our latest episode of Opening Bid. Hit us with those likes, follows, and subscribe wherever you get your vodcast, and join us for our first episode back after the holidays.
Welcome to Wealth. I'm Madison Mills in for Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks that you need to grow your money. On today's show, just a few days left in trading for the year. Is it time to start looking for potential opportunities in 2025? We'll get you some investment ideas from a portfolio manager on set in just a couple minutes. And could the housing market spring back to life in 2025? I'll speak with an expert about some good news ahead for home buyers. You won't want to miss that. And we'll also look ahead to your New Year's resolution for your 401k. We'll dive into everything you need to know for your retirement. That's all coming up today on Wealth. But first, let's take a look at some of the market action here 90 minutes into the trading day. Stocks sliding in the second to last trading session of the year. The Santa Claus rally failing to ignite and continue a rally off a record year for stocks. While the highs of the year were partly driven by that AI boom, we're looking at opportunities in AI and beyond in 2025. Roosevelt Bowman, Bernstein Private Wealth Management Senior Investment Strategist. He's here on set with me to discuss. Roosevelt, great to have you here. So we are seeing a little bit of a sell-off in some of those major big tech names, but what are you looking at for the AI trade that's driven so many of the market rallies and gains that we've had so far this year? What could that AI trade look like in 2025?
Well, first, thank you for having me, Madison. And I think the AI trade, it will evolve, right? What we've seen thus far is this focus on semiconductors and cloud computing. It really is likely to be a trade that evolves into something that's focused more on power, cooling, the other parts of making sure that you are able to run your models and get results from them.
And what does that sort of initiate in terms of the trade? We've been looking at the top performers year to date today, and a lot of them are some of those nuclear power names that we've seen hyperscalers making deals with. Do you expect that trend to continue?
We do. I mean, I think part of the reason is that the power needs for these models is tremendous. You know, whether you're talking about a data center that's running a large language model, those data centers often use 50 times the power that a normal data center does. So you're going to have to look to other energy sources, and I think that's where there's some real opportunity.
A lot of opportunity, but also a lot of risk heading into this year. And one thing I've been thinking a lot about as we head into year end is how we started this year with so much recession risk priced into the market. We were talking to all of our guests about it. Does it concern you at all that that's been sort of priced out at this point?
You know, I'd say it is at odds with our forecast. We are anticipating slower growth in the US. And to your point, what's interesting is over the past couple of weeks, you've seen economic data slow noticeably, but interest rates have still moved higher. And it's still kind of, and to your point, also pricing out of Fed rate cuts. So there's lots of optimism, and in our eyes, maybe too much optimism in terms of where US growth is likely to be. We're anticipating slower growth over the course of the year in the US and certainly around the globe as well.
And that's really interesting because GDP growth is something a lot of sources tell me is their number one barometer for market performance. So how does that impact your call on market performance for the year?
Yeah, I mean, I think for us, it does lead us to a more defensive stance, you know, focusing on healthcare. There's been a lot of talk around healthcare and some weakness there, but both from a tactical perspective in terms of slower growth that we're anticipating, but also longer term, when you look at the demographics in the US, the aging population, we do see that as an attractive sector. And also looking at consumer staples, you know, those industries and those products where consumers are still going to buy them regardless of how they feel about their job prospects and kind of current income levels. I do think that'll be important going forward. When we look at the consumer right now, higher income consumers are driving a lot of the growth. Lower income consumers starting to pull back some. You know, they've had to rely on credit more, and some of that credit is certainly becoming more expensive.
And that was on the front page of the FT today, the idea of just the credit delinquencies increasing so much due to inflation. Is this the year that we start to see the kind of bifurcation in income levels starting to really be a problem for the economy and the market more broadly?
It's certainly possible. I mean, it's something that has been talked about for a while and hasn't come to pass. But you know, if you think about those high-income earners, what's driving that consumption? It's the robust stock prices and, of course, the equity values and the homes going up. Right. So to the extent that those are threatened at all, that's where you could have some pullback in consumer sentiment in that cohort. And then all of a sudden, you're looking at both the high-income and the lower-income earners questioning how much consumption they're going to do going forward. And that is where you end up with slower growth.
What do you look at to determine when the kind of risks that we've talked about so far in this conversation become an actual problem for the market?
I think that it's a great question. I think there are a couple of indicators. One, looking at kind of overall household debt service levels. Now, that level has been noticeably below the 5-year average, but it's creeped up over the last couple of months where you're almost at the average. The other key factor, certainly the labor market. Labor market has continued to cool. When you look at the Kansas City Fed overall labor market indicator that's encompassing small business hiring intentions, the unemployment rate, all of those key factors, it's slowed noticeably. It's at basically a 3.5-year low. When you look at high frequency indicators that we love to follow, online job postings, the salaries associated with them, stabilize, but still at low levels. You know, you're still around 12 to 18-month lows there. So as the labor market continues to cool, that's going to push down some of that confidence that households have in terms of their spending. That leads to the slower growth.
I'm really glad you bring up the labor market. I pulled this stat for our conversation that full-time private sector jobs are down by 1.8 million year over year. We're seeing a lot of the growth coming in for government jobs still. As we get this kind of Department of Government Efficiency, whatever it's going to be coming in here, and we also have this cool down in private sector job growth. Should knowledge workers be concerned about the outlook for 2025?
You know, I think that it's not so much just those workers. I think just looking at the overall labor market, as you have that demand for either goods or services continue to recede, that's where you think about, okay, there's going to be some shifts there. I will say that overall in the labor market, to us, the big shift is something that started 5 years ago and is likely to continue, which is that employers are focused a lot more on skills rather than just experience. So I do think that there's some opportunity there. It's not just that, well, the labor market's slowing and that everyone across the board has weaker job prospects. It's more that as an employee, you kind of have to shift your mindset and think about being more viable across industries rather than just in your particular company focus area.
I think that's really good advice, Roosevelt. Thank you so much for coming in studio with us this morning.
Course.
We appreciate it. Thank you. We're going to move now to some of today's trending tickers. You can scan the QR code on your screen to track the best and the worst performing stocks of the session with our trending tickers page. First up here, MicroStrategy shares sliding as the company buys $209 million of Bitcoin, buying up over 2,100 Bitcoin tokens from December 23rd through to December 29th. Shares of MicroStrategy down roughly 45% from its all-time high seen a month ago, and you can see shares down a little over 7% in today's trade as well. Next up, let's take a look at V2X. The company is awarded a $170 million contract to support the Drug Enforcement Administration. V2X aiding in the support in the DEA's mission in combating drug trafficking. The 5-year contract will ensure continued operational readiness for the DEA's aircraft fleet, and this is a defense play, we should mention as well. Shares up nearly 1%. Lastly, shares of Vivid Seats popping as the company reportedly explores a sale. That's according to reporting from Bloomberg. The online ticketing marketplace working with an advisor to gauge interest from potential suitors. However, deliberations are ongoing and there's no certainty that this will lead to a deal. Shares popping, though, up 13%, briefly halted due to the gains, but you can see now they are still continuing to move to the upside. Let's move over to the housing market. Pending home sales rose 2.2% month over month in November, hitting a 21-month high and the 4th straight month of increases. Could this be an early sign that the housing market is finally going to unstick in 2025? Joining us to answer that and more, we've got Logan Mohtashami, Housing Wire's lead analyst. Logan, great to speak with you here. It's really interesting to me seeing just the degree of the uptick in housing market activity and pending home sales, specifically in the month of November. Is this a sign to you that buyers are finally capitulating to the Fed? They're not going to wait anymore for rates to come down?
It's been a really interesting second half of the year because when mortgage rates started to head towards 6%, we had about 18 weeks of positive purchase application data. And then our weekly pending contracts data has been positive year over year versus 2022 and 2023 data since October. So we're working from the lowest bar ever, so it doesn't take much to move the needle. But I think what surprised everyone is November and December rates were going up and purchase application data was still positive. I just think we have a very, very low bar of sales to work from, a little bit of seasonality coming in here, but it shows us that if rates just get towards 6%, you could get demand growth easily in 2025.
So what is going to be the single biggest driver of relief for potential home buyers in 2025?
You know, the economy softening up, the labor market softening up. If the unemployment rate starts to tick up higher than what the Fed is going to be comfortable with, that can take the 10-year yield lower. That's your best relief right now. The one positive for 2025 that wasn't the case the last few years is that mortgage spreads have gotten better too. So you don't need too much help from the 10-year yield, but you do need probably the economy to slow down just a little bit, just to get rates down towards 6%. And then you could get growth from these record low levels of sales.
And talk to me about also what you're anticipating in terms of just when buyers should really get into this market. If you're someone listening to this conversation and you've been wanting to buy a home, but you've been waiting for those lower rates, when is the time to buy?
I generally think the last few years, we've seen November and December be kind of the seasonal demand in purchase application data getting ready for spring. So I think we've already seen some of that happen already. But again, for everyone, it's the total cost of housing. Where do you live right now? Can you even qualify for a home? Housing affordability is still very terrible out there. So there's just a certain type of home buyer that could still buy. Most sellers are home buyers. In 2024, new listings data did grow. That's a positive. If we continue that trend, we could get some more traction, and active inventory is up in 2024. It's not back to normal, but these are positives for the housing market. Also, price growth cooled down in 2024 as well. So there's a lot of things that could get us to grow sales. It just needs the 10-year yield to go lower and mortgage rates just to go lower. And I think the pool of buyers pick up in that scenario.
We've seen the bond market, though, being particularly violent over the last couple of months, Logan, and certainly over the last year here. If we don't get relief in the 10-year, how does that impact home buyers?
I just think the existing home sales hovers around this 4 million level. It's been really rare after 1996 to have the existing home sales move below 4 million. But now, we don't have underwater mortgages. We don't have credit delinquencies in housing. We don't have credit stop flowing like we did after 2008. We have a lot of homeowners that are doing well, but it does require rates to come down. Every single time mortgage rates have head towards 6%, purchase application data grows, even with the home price gains that we've seen. So to me, it's just an affordability issue. We have good demographics here. There's a lot of selling equity. It's just an affordability thing. This reminds me a lot of the early 1980s when affordability was actually worse back then, but mortgage rates started to go down lower. There was an early recession in the early 1980s that boosted mortgage rates to go lower. That picked up demand noticeably back then, even though affordability was worse and we had actually more active inventory back then.
All right, Logan, we got to leave it there. Thank you so much for your time. Appreciate it.
Thank you.
Coming up, your Yahoo Finance market update. We'll check out how stocks are moving. Also run you through 3 stories you don't want to miss from your day. And finally, we'll talk about what to expect for your 401k heading into 2025. You won't want to miss it. Stay tuned. We are 2 hours into the trading day, and it's time for Yahoo Finance's Market Minute. U.S. stocks sliding in one of the last few trading sessions of 2024, hitting a sluggish run heading into year-end. Large-cap tech stocks struggling again, weighing on the major averages. Tesla, Amazon, and Meta sliding over 1% in Monday's trade. You can take a look at those stocks on your screen here. Tesla down over 2.5%. Also want to take a look at Boeing shares dropping as South Korean officials order an inspection of all Boeing 737-800 plane models. That order comes after the model was involved in a deadly plane crash. Turning to 2025, the New York Stock Exchange and the Nasdaq will be closed on January 9th to honor former President Jimmy Carter. There will be no stock trading that day on those averages, on those markets, as the U.S. holds a national day of mourning. And this is indicative also of something that occurs throughout history after the death of former presidents. You do see the market closing for that day of mourning, and that is going to be honored and noticed at the New York Stock Exchange and the Nasdaq again on January 9th. That's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, you can scan the QR code below to track the best and worst performing stocks of the day. More wealth when we come back. As we head to the end of the year, we want to set some New Year's resolutions to optimize our retirement savings. Today, we are diving into everything you need to know about 401ks Here are some tips and more. We've got Denise Appleby. She's the founder and CEO of Appleby Retirement Consulting. Denise, it's great to have you on here. I feel like this time of year can get a little overwhelming for folks with all the New Year's resolution content. At least that's a personal problem I'm having. So what is the single step that you can advise myself and our audience on to take to optimize their 401ks for 2025?
Well, this is a time to look back at what went right and what didn't go right, right?
Mm-hmm.
And so what you want to do for 2025 is continue to implement what worked and changed what didn't. I'm finding that a lot of individuals did not maximize their 401k contributions as much as they could have, and now they're having regrets. Come next year, you want to make sure you pace those contributions. Even if you want to max out your contributions, you want to look at it sort of like a budget. As you create your budget for the month, as you create your budget for the year, include your 401k contribution. Yeah, I know I started out with maximizing contributions because many people want to do that, but you also have to think about affordability. Mm-hmm. Because here's what I'm seeing too. Individuals contributing the maximum amount to their retirement account, and then they have no money left for everyday expenses. I'm talking about, regular people who are living paycheck to paycheck. So you want to make sure that the amount that you contribute does not cause you to have to live on your credit cards, because whatever you're earning on your 401k contributions, the interest that you pay on credit card is going to offset that. And usually credit card interest is much higher.
It's such a great point and really helpful context. For those who do feel comfortable with their contribution, they're, let's say, maxing out their 401k, they've got a great employer match. Should they be working to optimize those contributions by actively managing their 401k investments, or do you recommend a more passive portfolio management process?
You know what? You really want to get your financial advisor involved, because there's no such thing as a one-size-fits-all solution. Here's what I do. Right now, we're at the end of the year, and one of the last things that I'm doing for the year is meeting with my financial advisor. And as much as I like to think I'm an expert in this area, I'm not an expert when it comes to investing. So I meet with my advisor and I ask her, what should I do for next year? Should I max out my contribution? What about my investments? And rightly, she'll say to me, Denise, I'm not an investment advisor, but you want to talk to someone who is. Your CPA, your financial advisor, who's proficient in the area of managing investments. And part of what they'll do is look at not just at your 401k, but your overall portfolio. Because one of the mistakes that people make when they meet with their financial advisor is look at one particular account. You want to let your financial advisor know, yeah, I have this 401k, but guess what? I have an old 401k elsewhere. I have a 403b account. I have an IRA. And so when we rebalance our portfolio, let's take a look at all of those to make sure that we're dealing with a portfolio that is suitable for my investment profile.
And talk to me about that. What is a mistake that you see individuals making when it comes to maybe they're switching jobs and maybe they're losing track of their 401ks along the way? How can folks take that into account heading into the next year?
There are a lot of people writing about when you leave your old job, should you take your 401k with you? Mm-hmm. And so here's what I'm going to talk about, since everyone else is talking about that. Let me tell you the number one problem I'm seeing. Right now, I'm dealing with a spouse beneficiary who inherited $5 million from her husband. She didn't touch it. She was waiting to talk to her financial advisor, but the mistake she made was to wait too long. Then she gets a check in the mail for $5 million saying, our sympathies on the death of your husband. Here is your inherited 401k balance. And guess what? You can't roll it over. And of course, she's shocked because she's thinking, I know I've read that spouse beneficiaries have all these options available. But the problem was, under the 401k plan, they gave her 5 years to fully distribute the account. And if she didn't do anything, then at the end of the 5-year period, the entire amount becomes what is referred to as a required minimum distribution. Mm-hmm. Now, the problem is anything that is categorized or defined as a required minimum distributions cannot be rolled over. So here she is with a $5 million check thinking, oh, this is going to go into my retirement savings. I'm going to start withdrawing when I reach age 73, take a little bit every year. But now she's faced with a lump sum income of $5 million. So my advice to beneficiaries is, and participants too, have that conversation with whoever is the beneficiary of your 401k. Let them know what to do in the event of your death. And if you're the beneficiary, sure, we don't want you to make a mistake. And if you rush, it's very likely that you're going to make a mistake. But reach out to a financial advisor that understands the distribution options for beneficiaries. Can you roll it over to a beneficiary IRA? And how soon can you roll it over? Because if that plan says you got to get out of there within 90 days, after 90 days, you're going to get a check in your hand and there's nothing you can do other than included in income.
Right. It's a great example, Denise, too, of just how if your finances are a bit more complicated, maybe you do choose to seek out that financial advisor piece. Denise, thanks so much for your advice today. Really appreciate it.
Thanks for having me on. Much appreciated.
I want to do a quick check of the markets before we head out for you. We're still seeing moves to the downside in stocks. You're taking a look at the S&P and the Nasdaq still declining. That's it for Wealth Today. I'm Madison Mills. Thanks for watching.
All right, welcome to a new episode of Opening Bid. I'm Yahoo Finance Executive Editor Brian Sozzi. This, of course, is the podcast that will make you a smarter investor. And joining me today, special guest alert, that is Yahoo Finance Senior Reporter Brooke DePalma. Good to see you.
Good to see you too.
All right, our feature interview today is new Chipotle CEO Scott Boatwright. Scott, good to see you. Welcome to Yahoo Finance. It's been a while. Good to see you.
Good morning, Brian, and good morning, Brooke. Happy to be on this morning.
You know, we're
looking forward to talking about the business.
I'll be doing better once I have my 5-pound burrito from Chipotle for dinner, sir. Like, I mean, let's just be honest. I mean, I know you're not going to tell me it's 5 pounds, so I don't expect you to. But I'm just telling you how I load mine up. So before we talk about the business of Chipotle, I think our community and the investing community in Yahoo Finance, they haven't met you before. And you started what, as a dishwasher? Where did you start as a dishwasher? Like, tell me about your career journey.
Yeah, Brian. I've been in this industry for many, many years. And so I started out as a dishwasher in high school at a steakhouse in my local community. And I really found a passion for the business. I had this approach to hospitality, this service mentality, really at a young age. And, I don't know if that came from high school athletics or the way my parents, helped me mature and grow into the person that I am today. But, I found a passion for it early on. And that was over 30 years ago now, Brian.
Well, from one dishwasher to another. So I used to wash dishes at a local country club. I know what it was like for me, but what was it like for you?
I can't tell you it was all roses, Brian. So as you can imagine, on a busy, bustling night in a restaurant, the loads of smallwares, plates, and pots and pans coming from a kitchen as a 16-year-old can be a bit overwhelming. And the nights were typically pretty late. The restaurant would close down around 11:30 at night. And so you're there 12:30, 1 a.m. trying to get homework done and get to school the next morning. So challenging times, but very rewarding nonetheless.
Scott, eventually you did work your way to Arby's. You were there for 18 years, I believe. What lessons did you learn from Arby's that you brought to Chipotle about now? What has it been, 7 years since you joined Chipotle?
It has. I was very fortunate to join Arby's at a time. I was going through a pretty sizable transition. The company at the time that I joined was a franchise group called RTM, which was led by Russ Umfenhauer. Don't know if you know that name. I think he's an industry icon. And, I learned a lot about goal setting in the early days. I learned a lot about leadership. I learned about, people development. The byproduct of all those things that we were leaning into was delivering a great experience and roast beef sandwiches. But the business was really about people. And it always has been, Brooke. And so, I don't know that I'd be the leader I am today had not I had that experience with RTM in the early days. That matured. We actually took that company or sold that company back to the parent company, Triarch, around 2005, and ended up taking Arby's public that next year.
Scott, if you had to, if you were going up into space, you had to take one meal. I mean, is it the Arby's roast beef sandwich or a Chipotle bowl? Now, you don't have to say Chipotle because you work there.
That's a tough call.
Come on, you got to pick one.
There's a bit of irony and maybe serendipity here. When I was the region vice president for Arby's, operating out of the Dallas market, one of my go-tos was a Chipotle Mexican grill right around the corner from my office. I spent a lot of time there. I fell in love with this brand when I was first introduced to it back in 2006, 2007 timeframe, and I've always been a huge fan. So you can imagine the day I got the call from Steve Ells to talk about the business, I was ecstatic and excited to say the least. And it's kind of funny, at the time we were doing really great things with Inspire Brands. Rourke Capital owns Inspire Brands today. Paul Brown and I and others were really pulling Arby's out of a rut coming out of the Great Recession. The brand was doing great things, on fire, which allowed them to really build out the Inspire Brands that it is today. But I'll tell you, Chipotle was in my heart, and when the phone rang, I jumped at the opportunity.
Good answer there. Good answer there. So one of the benefits, we're almost, we'll have taped 100 episodes very soon on Opening Bid. And one of the benefits of that, we've talked to some amazing people. One of them we talked to is one of your competitors. We talked to the co-founder of Sweetgreen, and Nicholas Jamay, he proceeded to talk about how they're building robots into their restaurant. I want to call them robots. There's just a lot of automation that will build your bowls. Now, you've invested in a company like Hyphen? When are we going to see And when are we going to see bowls made by automation at Chipotle? From the outside looking in, this makes a lot of sense to me. I mean, maybe some labor savings, you move faster, I get orders out the door quicker. What's the roadblock?
Well, you'll not likely witness your bowls being made. We fully intend to leverage that automation in the digital system only. We still believe the best way to Chipotle is down the line with a team member, highly customized, great variety, big, beautiful burritos and bowls down the line with that human interaction is still a core equity of the Chipotle brand. So we will use that digital line once we put it in a restaurant a few months ago. We ran some, and we're moving it through our stage gate process. Now you've heard us talk about that, Brian. The goal here is to continue to iterate and refine that piece of equipment and get it into restaurants sometime in the future. But it'll be primarily in the digital system, making bowls and burritos for us through the digital channel.
Scott, you are a true ops guy. I think everyone on the street knows that. When I went to a recent Chipotle, I was shocked at the fact that there was so much inventory in the digital make line, and then some of my favorites wasn't in the actual make line that I ordered from. How do you think about inventory levels in the physical make line when you go to a store versus the digital make line?
Wait, Brooke, what'd you order? What'd you order?
I'm always a go-to.
Just curious. Oh, go ahead, Scott.
Chicken always.
Go ahead.
Yeah, I don't know what the specific circumstance there was, Brooke. We should always be in stock on both lines, all hours that we're open. And so, we do have a system that cooks food real time. We don't believe in holding our food on the line. It has a very short shelf life, and we try to move through that product with a lot of velocity. As you know, Brooke, we're using highly fresh ingredients, no GMOs, no hormones, no antibiotics, no preservatives or additives. So we have to manage inventory levels probably more aggressively than our competitors because of the real food that we're preparing and making for the line.
How fast are you getting out these digital orders? How quick does it take to make? I feel like before I even say I'll pick up at 12:45, I get there and on the dot, it's already there. So how fast are you making the digital orders and how much opportunity do you have there to increase speed?
Yeah, it only takes about 30 to 60 seconds to complete an order on the digital make line, Brooke, obviously depending on the complexity or the size of that order, if you will. So it moves through at a pretty rapid pace. We do throttle orders into the digital system, but on average, through our third-party partners, you can get a bowl of burrito within about 30 minutes to your chair anywhere you're sitting in the world.
Scott, I think I saw it was a video on the Hyphens website, and they were making what looked to be Chipotle bowls. Now you're investing in this company. What is that? What is that machine? Are you testing that in Chipotle restaurant? It looked like a table, and then up popped a bowl. Somebody pushed the bowl down the line. Is that the future? Because theoretically, rolling that out somewhat chain wide, that's going to fall on you. You have to make a bet on the next decade of Chipotle's life.
Yeah, and I agree. It is a very bespoke piece of equipment, leveraging our team, our robotics, I should say cobotics team here at Chipotle with the Hyphen team to really come up with something that is very unique, very innovative in our opinion, that is able to deliver a great customized bowl in real time. And so we feel really good about that innovation. But it's only one component of our innovation strategy. There are a handful of innovative pieces of equipment that are moving through stage gate as we speak, some short range, mid range, and long range. The table, the Hyphen table, the augmented make line as we call it, is one of the more long range pieces of innovation. But it is my endeavor to really modernize the kitchen at Chipotle. It's been exactly the same for 30 years. We still bring that experience to life, leveraging classic culinary techniques. So think pots, pans, knives, cutting boards, and stovetops. So again, my endeavor is to make it a more modernized experience in the back of house, but staying true to who we are at core Chipotle around this idea of classic culinary and not walking away from that because we think that's a core equity of the brand as well.
Well, two-part there, Scott. How specifically are you going to modernize a Chipotle back of the house restaurant? I mean, you are the ops guy. I mean, this is your thing. And then if you do modernize it, does that finally unlock another day part for Chipotle? Is this finally the moment where you could say to the board, you could say to investors, damn it, we're going to start selling breakfast finally. We're going to get a breakfast burrito out the door before 10 a.m.?
It certainly could, Brian. I won't say that it will or that we have intentions of rolling out another day part anytime in the near future, but it certainly could allow us to be much more efficient in the prep process. So that would free up opportunity for other platforms. You know, I'll tell you, if you come into one of our restaurants today, it looks like a true farmer's market. Yeah, there are boxes of romaine lettuce that have been cut fresh from the field, shipped directly to our restaurants. There are, you know, bags of onions, peppers, bell peppers, and jalapenos. That it looks, again, like a true farmer's market. So I call it, when I think about, you know, we'll be at 3,700 restaurants by the end of the year, Brian. And what's really unique and cool about our brand is when you walk into our restaurants, it looks like a mom and pop. And we are able to deliver that mom and pop experience at scale, which I think is a credit to the operators that we have in the field and how incredibly strong they are at delivering the experience.
Scott, hang with us. We're going to go off for a quick break. We'll be right back on Opening Bid. All right, welcome back to Opening Bid. Having a great chat here with Chipotle's new CEO, Scott Boatwright, and Yahoo Finance's very own senior reporter, Brooke DePalma, who covers Chipotle. And your team knows this, Scott. I go to Chipotle and I get these really large
double
portions.
protein,
double protein.
steak,
Like, I am the double guy. I eat 2 bowls. I've sent photos to your team. They know it. I'm not going to repeat the stuff. We've talked about it before. But how much longer can you continue to make or offer these very large portion sizes? The costs of everything, whether it's labor, ingredients, they continue to go up. At some point, you have to say, look, we can't give you double of these things, even if you're willing to pay for it.
Yeah, it's a great question. And I think a lot of brands today are struggling with that very question, Brian, as they think about how do you continue to drive top line transactions and sales and then manage margins aggressively. So we're dropping money to the bottom line. As you know, Brian, it's the restaurant business has been a penny profit business for many, many years. When a lot of our competitors are running towards optimization, menu optimization, and value through pricing, we think about value very differently at Chipotle. And when I think about value, I think about it as an equation, as benefit over price. And so as price moves up, benefit has to improve at the same pace to keep value the same for the consumer. Benefit, in my mind, is incredible abundance, great variety, ingredients freshly prepared that you can't get anywhere else at a speed which is unprecedented at a great price point. I'll tell you, Brian, our chicken burrito on average in the US today is still under $10. And if you stack that up against any of our competitors in the space today, we're still a 10 or 20% discount to our competitors. And we're going to continue to give you more in your bowl and burrito than you'll get anywhere else.
Scott, so happy to hear that it's still $10. I know that Chipotle is set to take another price hike next year, roughly 2%. What's driving that? And do you really think that consumers can swallow another uptick in cost?
Yeah, great question, Brooke. So we most recently took a 2% price increase action to merely offset inflation we're seeing in the business. Recall, we haven't taken a price increase in over a year in the core business. And so we're seeing inflation in cost of goods. We're seeing labor inflation, albeit modest, but we're leveraging that 2% price increase to merely offset the inflation we're seeing in the business. Again, still driving incredible value for the consumer and still well underpriced our competitors in the space.
I know that under $10 price burrito it's a badge of honor inside Chipotle. We've talked about it years with longtime CFO Jack Hartung. He always calls it out. But how much longer can you keep that price under $10? We got wages out there in California, Scott. I mean, they've gone through the roof. They've gone through the roof in many places across this country. Avocados, more, everything costs more. At some point, is the reality a burrito at Chipotle is just going to cost more than $10 and we have to live with it?
Yeah, and Brian, it's a great question. And I think about it as though, how can we risk mitigate other inflationary pressures by being more efficient within either our supply chain or our operating model? So with supply chain, we have been beholden to Mexico and California for avocados for many years. And over the last 18 to 24 months, we've diversified away from Mexico into Peru, Chile, and Colombia to manage costs long-term for the system. We'll do the same thing within our restaurant operations as well, looking for ways that we can mitigate costs, either rising labor costs or just being more efficient in the back of house by leveraging the technologies we talked about earlier.
I do quickly want to hit on speed. I know that is part of the value equation at Chipotle. How long does it take during peak 15 to 30 minutes? Where are you at now with adding that 5 incremental orders to the speed?
Yeah, we know that speed is a core equity, Brooke, at the Chipotle brand, and we lean into it pretty aggressively. We talk about it a lot. We spend a lot of time on earnings calls talking about being more efficient down the line. Our restaurants that are most efficient at peak in highly trafficked areas, so think major metro, downtown Chicago, can deliver the Chipotle experience in about 9 to 10 seconds down the line. So that tells you the power of our throughput model when we do it and we do it well. We still have wood to chop as it relates to throughput by being properly deployed at peak and ensuring that we have aces in their places in the right position to move the line as quickly as possible. Part of our challenge is getting that massive prep process completed early in the morning and all the prep put away so we can be deployed appropriately at peak. One of the things we're doing there to change the way we think about it is we're going to bring in produce slicers, which we talked about on the last earnings call, to make us much more efficient in the morning so we can have consistent cut sizes, I believe better culinary than we have today across our 3,700 restaurants.
So many companies are talking about getting labor in the door. You guys are talking about filling what you call an expo role between the salsa and the cash register. What exactly is this expo role? Should other companies be looking into this too?
Well, Brian knows this from his restaurant days.
Oh, don't bring me back, man. No, they kept me in the back, Scott, washing those dishes.
You didn't get that role, right?
No, I do. I ate the food off the dirty plate. We'll take that offline. It's all true. It's all true.
I love it. I love it. So it's effectively an expediter, Brooke. It's someone that is coordinating what's coming down the table, bagging the orders, and communicating to the cashier what to appropriately ring in for the consumer. And it just creates a level of efficiency on the line that is absolutely necessary at peak.
How many restaurants have this role?
Today, well, every restaurant should have the role, Brooks, to be clear. Today, we're averaging about 60% of our restaurants have an expo position in place at peak that is moving the line effectively for the entire peak. And that's something we monitor and review consistently to understand how we're performing against that key metric.
I happen to think, Scott, Chipotle, and I've said this for a while, I think you have an opportunity in coffee. I mean, that's just my view. I mean, do you want to go head to head with Brian Niccol? I mean, who's now your former boss, and he leads Starbucks, but why not serve a great, large, Mexican-themed iced coffee? I'll pay more. To me, it makes sense, but maybe it doesn't make sense to you, the operations guy.
It's a great question. And, I still see Brian pretty consistently. We work out at the same gym together. We still live in the same community.
Well, thanks for the invite. I wouldn't mind,
Seriously, what's this gym?
Yeah, I mean, just send me the invite next time.
Yes. You have to come down to Southern California. Both of you next week. Get in the gym early. We start around 5 a.m.
Wow.
Anyway,
awesome.
we'd love to have you out. But, I think coffee's a neat idea. I think once you get to a point in the business where you need to launch breakfast, you got to have a great cup of coffee. And so, whether that's a partnership or something you spin up on your own, innovate against coffee today, could be meaningful, but I think it's necessary.
What is the key differentiator between Chipotle under Brian Niccol and Chipotle under Scott Boatwright?
Yeah, I get that question a lot, Brooke. And, Brian and I are a lot alike in many, many ways. And the reason we were so complementary as we worked together over the past 6-7 years, I think there are a couple of things that I think differently about the Chipotle brand. A couple of those is one is modernizing the restaurant back of house. I think is a critical component to us getting to 7,000 restaurants in North America, and then how we think about international growth. I also want a more connected Chipotle brand. As an operator, as you can imagine, I want everyone here to be in service of our guests in a really meaningful way. And I talk about this mantra that I have, that at Chipotle, you're either serving a Chipotle guest or you're serving someone who is serving a Chipotle guest. So a more connected community that understands the tie all the way to the consumer. And then lastly is this idea of a global iconic brand. I think about as Steve Ells, founded the brand and grew it to, just around 2,000 restaurants in a really meaningful way as the founder of the business. He handed that off to Brian, and Brian, stabilized the business, got it growing again, and really made it a national brand with leveraging national marketing, connecting with consumers, and driving brand relevance and brand love. It'll be my endeavor, if you think about it in phases, in this third phase of growth for Chipotle, continue to drive incredible North American results in same-store restaurant sales and new unit growth. But then think about how do we show up internationally on the international stage, whether that's growth in Western Europe or international partnerships like the one we have with Alshaya today.
Scott, long-term goal here is 7,000 restaurants. What do you think is the biggest challenge when you go to these new markets? Is it awareness? Is it getting people on board to come in? What is the challenge here?
There's really not a significant challenge in front of us, Brooke. I joke, and I say this jokingly, I could open a Chipotle restaurant in a field in Iowa, and people will find their way to that restaurant.
Yeah, I'll be there. I'm there already. Open it up, Scott. Thank you.
And so, we are showing a lot of great progress and strength in some of the smaller communities that we go into. This small town strategy we leaned into about 18 months ago is paying huge dividends. And I think that's a credit to what this leadership has accomplished and really making Chipotle a national brand and driving brand relevance and brand love and making it more visible. And so, our challenge will always be We can build as many restaurants as we can actually sign leases for. The challenge will always be around growing and developing talent within the organization and being prepared for that growth as the years unfold.
In the last 2 minutes, Scott, we always like to ask our guests some hot takes. We don't know where it's going to go. I'm actually just pulling this out of thin air right now. Pretty much nothing is written down, as you can see on my paper. So my hot take for you is this. Both you and Brian seem like pretty relaxed guys. Like, how do you deal with stress? And as an operations guy, how do you get out of the weeds? Is it hard to delegate?
Yeah, great question, Brian. There is stress, and I don't know that it's masking stress, but more managing stress in the most appropriate way. It's a challenging business environment. You've got to be able to synthesize large volumes of data in a really meaningful way. Stay true to your strategy, stay true to your purpose, and keep putting one foot in front of the other is what I would tell people. You can't let the things that are out of your control, external influences, drive you bananas. Again, stay true to who you are, stay true to your strategy, stay true to your purpose, and good things will happen.
When you're not eating Chipotle, what's your go-to? Do you like to barbecue? What are your go-to items? Are you a chef? Are you a cook? Like, tell us more about yourself.
I love to cook. I'm a huge cook. My wife loves that about me as well, because I don't think she likes to cook. But just spending time with family, socializing over a meal is how I like to spend my time.
Scott Boatwright, we're wishing you much success over at Chipotle. Big job, big goals, getting to 7,000 restaurants while continuing to serve up sub $10 burritos. Scott Boatwright, good to see you. Looking forward to staying in touch. And a special thank you to our very own Brooke De Palma, senior reporter at Yahoo Finance. And that is it for the latest episode of Opening Bid.